Imagine waking up tomorrow morning and checking your bank account. The balance hasn't changed. But something else has. That coffee you bought yesterday for $4 now costs $7. Your grocery bill doubled. Your mortgage payment stayed the same. But everything else became unaffordable overnight. Not because of a stock market crash, not because of a war, but because the world stopped trusting the dollar. For over 80 years, one currency has ruled the global economy. It financed wars, it shaped empires, it became the foundation beneath every major transaction on Earth. But right now, that foundation is quietly cracking, and most people have no idea what's coming. Welcome to the Financial Explorer. Today, we're diving into what happens if the US dollar loses its global throne. The story of the dollar's dominance didn't begin with some economic theory or random historical accident. It was engineered, deliberately, strategically, and for decades it seemed unstoppable. To understand what's happening now, we need to go back to July 1944 to a resort hotel in Bretton Woods, New Hampshire. World War II was still raging, but the Allied powers were already planning for what came next. 44 nations gathered around conference tables to redesign the architecture of global finance. The question on everyone's mind was simple but urgent. How do we prevent another Great Depression? How do we rebuild a shattered world economy? The answer they created was radical. Every major currency in the world would be pegged to the US dollar. And the dollar itself would be backed by gold at a fixed rate of $35 per ounce. This wasn't just monetary policy. It was a power grab, and America was in the perfect position to take it. The United States emerged from the war with its infrastructure intact. It held the largest gold reserves on the planet. Its industrial capacity dwarfed everyone else's. Other nations didn't just accept this arrangement, they welcomed it. They needed stability, and the dollar offered exactly that. But then came 1971. President Nixon walked into the Oval Office and made a decision that would change everything. He announced that the United States would no longer convert dollars to gold. The Bretton Woods system was over. Economists panicked. Foreign governments panicked. For a brief moment, it looked like the entire global monetary system might collapse. But it didn't, because almost immediately, a new system took its place. The petrodollar. In the mid-1970s, the United States struck a series of deals with oil-rich nations, especially Saudi Arabia. The terms were straightforward. Saudi Arabia and other OPEC members would sell oil exclusively in US dollars. In return, the United States would provide military protection and political support. It was a brilliant move. Oil became the most traded commodity on Earth. And if you wanted oil, you needed dollars. It didn't matter if you were in Japan, Germany, or Brazil. You had to hold dollars to buy energy. This single arrangement locked in dollar dominance for the next 50 years. Even today, over 80% of global oil transactions are conducted in US dollars. But it wasn't just about oil. Over time, the world began using dollars for everything. Central banks stockpiled them as reserves. Governments issued debt in dollars. Companies borrowed in dollars. Trade between two countries that had nothing to do with America was still settled in dollars. Why? Because the world trusted the US economy. It had the deepest capital markets, the strongest legal system, the most powerful military, and that trust created what economists call exorbitant privilege. America could borrow more than anyone else. It could run larger deficits. It could import goods cheaply and export inflation, all because the rest of the world needed its currency. For decades, this was treated as a permanent feature of the global economy. But permanence in finance is an illusion, and today, that illusion is starting to crack. The shift didn't start with a bang. There was no single moment when the world decided to move away from the dollar. Instead, it's been a slow, quiet, and deliberate process. A process driven not by ideology, but by fear. Fear of what the United States might do with its financial power. Let's start with the most visible crack. The U.S. national debt recently surpassed $37 trillion. To put that in perspective, that's more than the entire gross domestic product of China, Japan, Germany, and India combined. And it's not just the size that worries foreign governments, it's the dysfunction surrounding it. In recent years, the United States has repeatedly come within days of defaulting on its own debt, not because it couldn't pay, but because Congress couldn't agree on whether to authorize payments for spending that had already occurred. These debt ceiling crises have become routine political theater in Washington. But to the rest of the world, they send a very different message. That message is simple: America can't manage its own finances. But there's something even more alarming to foreign governments: the way the United States uses the dollar as a weapon. When the U.S. imposes financial sanctions, it doesn't just restrict trade. It can cut entire countries off from the global banking system. The tool it uses is called SWIFT, the Society for Worldwide Interbank Financial Telecommunication. SWIFT is a messaging network that connects more than 11,000 financial institutions across the world. It's the backbone of international payments, and the United States has enormous influence over it. When Washington decides to sanction a country, it can essentially exile that nation from the dollar-based financial system. That's exactly what happened to Russia after it invaded Ukraine in 2022. Russian banks were cut off from SWIFT. Hundreds of billions of dollars in Russian foreign reserves held in dollars were frozen. Russian companies couldn't make cross-border payments. Overnight, Russia was financially isolated. The same thing happened to Iran years earlier. Whether or not you believe these sanctions were justified, one thing is undeniable. The United States demonstrated that it has the power to freeze entire economies at will. And that power makes other countries nervous, because if it can happen to Russia, it can happen to anyone. That's why we're seeing something unprecedented: a coordinated effort by multiple countries to reduce their dependence on the dollar. This movement is most visible among the BRICS nations: Brazil, Russia, India, China, and South Africa. These 5 countries represent over 40% of the world's population and more than a quarter of global GDP. And they've made it clear: they want alternatives. Russia, facing sanctions, immediately began trading oil and gas in rubles and yuan. India, which historically settled almost all of its energy purchases in dollars, signed a deal with the United Arab Emirates to pay for oil in rupees. That was a seismic shift. But the biggest move came from China. In 2024, China purchased crude oil from Saudi Arabia and paid in yuan. This was the first time in over 50 years that Saudi oil was sold in a currency other than the dollar. It wasn't just a transaction, it was a geopolitical statement. And it didn't stop there. Even France, a core European Union member and a longtime U.S. ally, finalized a liquefied natural gas deal with China and paid in yuan. It was the first time a Eurozone country used Chinese currency to pay for energy. These deals may seem small individually, but together they represent a pattern. The world is quietly building parallel financial systems that don't require the dollar. Central banks are shifting their strategies too. For decades, holding U.S. Treasury bonds was considered the safest investment on the planet. Central banks around the world treated them like savings accounts. But now, many are diversifying, and they're doing it in one very specific way. They're buying gold. In 2023 alone, central bank gold purchases hit an all-time high, over 1,000 tons. Why gold? Because gold is no one's liability. It can't be frozen by sanctions, It can't be devalued by a foreign central bank. It's a hedge against uncertainty. And right now, central banks see a lot of uncertainty. All of this has given rise to a term that was once fringe, but is now mainstream. Dedollarization. In Latin America, Africa, Southeast Asia, the so-called Global South, governments are asking a simple question. Why should our economies be tied to decisions made in Washington? If our country has nothing to do with us politics, why should our currency reserves, our debt, and our trade depend on the dollar? And here's where it gets even more interesting. Technology is now giving countries new ways to move money without the dollar. Over 100 nations are currently researching or piloting central bank digital currencies, or CBDCs. These are digital versions of national currencies, programmable and controlled by the state. China is leading the charge. Its digital yuan has already been used in cross-border payments with Thailand and the United Arab Emirates. These digital payment rails could eventually become the foundation of a financial system where the dollar simply isn't needed. The BRICS nations have also floated the idea of creating a common settlement currency. It would potentially be backed by a basket of commodities or local currencies. The idea is still early and controversial. There are massive concerns about which country would have the most influence, but the direction is clear. They're building an escape hatch, a way to trade, save, and lend without relying on the US dollar. But here's the problem. There's no obvious replacement. The Chinese yuan is tightly controlled by Beijing. It's not freely convertible. Investors can't move money in and out of China easily, and they don't trust the legal system to protect their assets. The euro looked promising when it launched in 1999. But the eurozone is politically fragmented. It lacks a unified treasury or common fiscal policy. That makes it less reliable during crises. And a BRICS currency? It remains theoretical, more of a signal than a functioning alternative. So for the first time in decades, the question isn't whether the world can live without the dollar, it's how soon it might try. So what actually happens if the dollar loses its throne? Let's walk through the dominoes. The first to fall would be a massive sell-off of US assets, starting with treasury bonds. Right now, foreign governments hold over $7 trillion in US debt. Countries like China, Japan, and Saudi Arabia hold over $2 trillion combined. If they start dumping those holdings, the bond market doesn't just wobble, it collapses, prices crash, yields spike. Suddenly, the US government has to offer much higher interest rates just to attract buyers, and that makes everything more expensive. When Treasury yields rise, interest rates across the entire economy rise with them. Mortgage rates, which determine how much you pay on your home loan, would soar. Credit card rates would surge. Small business loans would become far more expensive. In simple terms, borrowing money for anything, whether it's buying a house, starting a company, or covering an emergency expense, would become painfully costly. And that guarantees an economic contraction. At the same time, a weaker dollar starts eroding your purchasing power. The United States imports over $3 trillion worth of goods every year: electronics, machinery, clothing, pharmaceuticals, food. If the dollar weakens, every single one of those imports gets more expensive. That's inflation. But not the temporary kind we saw after the pandemic. This would be structural, persistent. Your paycheck stays the same, but your grocery bill doubles. Gas prices jump. Medicine costs more. The dollars you saved lose value, not because you spent them, but because the world decided they're worth less. And then there's the geopolitical fallout. America's ability to impose sanctions, to influence trade policy, to shape global financial rules, all of that is tied to dollar dominance. Lose the dollar's centrality, and you lose leverage. The US wouldn't be able to freeze assets or cut countries off from the financial system as easily. That's a massive loss of soft power. For developing countries, the consequences could be even more severe. Many emerging markets hold huge amounts of dollar-denominated debt. If the dollar's value becomes unstable, or if global trust collapses, those countries face a refinancing crisis. They borrowed in dollars but earn revenue in local currency. A currency mismatch like that can trigger defaults, economic collapse, and social unrest. Trade itself fractures. Instead of one unified global economy, we could see the rise of currency blocs, a yuan zone in Asia, a euro bloc in Europe, maybe even a BRICS currency area. Each region would trade mostly within itself, and the system that connected everyone would fragment. Efficiency drops, friction increases, and back home in the US, daily life gets harder. Groceries cost more, gas costs more, healthcare costs more, the cost of living climbs. Meanwhile, the stock market, long a symbol of American financial dominance, starts looking less attractive to foreign investors. As capital flows out, volatility spikes, market corrections become more frequent, retirement accounts lose value. So if the dollar truly falls from its throne, life in America would change. Maybe not overnight, but profoundly. Now, everything we've laid out might make it sound like the dollar's collapse is inevitable. But that's not the full story. Despite all the cracks, despite the rising concerns, the dollar is still deeply embedded in the foundation of the global economy. And dismantling that foundation won't happen quickly. Let's start with the numbers. As of early 2025, the US dollar still makes up around 59% of global foreign exchange reserves. Yes, that's down from about 70% 2 decades ago. But it's still more than double the euro's share, which sits at around 20%. And it's far ahead of the Chinese yuan, which accounts for only about 3% of global reserves. Put differently, central banks worldwide still hold over $6 trillion in reserves. And they're not holding that money out of charity. They hold it because the dollar is still the most liquid, most trusted, and most accessible currency in the world. Why does trust matter so much? Because finance runs on confidence. The euro, for all its promise, has never fully replaced the dollar. The eurozone is politically divided. When crises hit, like the sovereign debt crisis of 2011, the euro struggled to respond. Europe doesn't have a single treasury. It doesn't have unified fiscal policy. That makes the euro less reliable. Then there's the yuan. China is now the world's second largest economy, and Beijing is aggressively pushing to internationalize its currency. But the yuan has one fatal flaw. It's not freely convertible. Beijing tightly controls capital flows. Investors can't move money in and out of China easily, and they don't trust the Chinese legal system to protect their investments the way they trust American courts. Trust is everything in finance. And despite America's rising debt and political chaos, the world still trusts the US system more than the alternatives. Beyond trust, there's infrastructure. The dollar is woven into the machinery of global commerce. Take SWIFT. The global payment messaging system used by over 11,000 banks worldwide. The vast majority of SWIFT transactions are still settled in dollars. Then there's the energy market. Most oil contracts, whether from Saudi Arabia, the US, or Qatar, are still priced and paid for in dollars. The petrodollar system, established in the 1970s, remains intact. Yes, France bought liquefied natural gas from China in yuan in 2023. But that was the exception, not the rule. The system hasn't shifted. It's just starting to crack. Dedollarization is real. It's happening. But dismantling a system that took 80 years to build doesn't happen in a weekend. It's a process that will take decades, not days. Think of it like turning an aircraft carrier. Momentum matters, inertia matters. And for now, the dollar still has both. But there's one fear that keeps coming up whenever people talk about the dollar losing dominance. Hyperinflation. The word alone conjures images of people pushing wheelbarrows full of worthless cash just to buy bread. Germany in the 1920s, Zimbabwe in the 2000s, Venezuela today. Could that really happen in the United States? Let's be clear, the risk is not zero, but it's extremely low unless several dangerous factors align all at once. The first trigger would be uncontrolled money printing. When a government prints too much money without a corresponding increase in goods and services, prices rise. That's inflation. When it spirals out of control, you get hyperinflation. The Federal Reserve did expand the money supply rapidly during the COVID-19 pandemic to stabilize the economy. But since then, it's reversed course. It raised interest rates. It shrank its balance sheet. As of 2025, inflation in the U.S. has cooled significantly. Year-over-year consumer price index growth is now under 3.2%, well below the double-digit spikes of the crisis. Hyperinflation would only become likely if the U.S. completely abandoned fiscal discipline. If it started running even larger deficits and funding them entirely by printing money instead of borrowing. So far, that's not happening. The second possible trigger is a global rejection of dollar assets. If foreign countries suddenly dumped us treasuries, stopped holding dollars, and refused to lend to the U.S. government, the Federal Reserve would face an impossible choice: raise interest rates to extreme levels to stop capital flight, or print more money to cover the gap. Either option could destabilize the economy. But this scenario is also unlikely, because there's still no global alternative with the size, depth, and trust needed to replace the dollar. A third potential tipping point would be the loss of Federal Reserve independence. Right now, the Fed operates with some autonomy from political pressure. That allows it to focus on long-term stability. But if politicians started demanding that the Fed fund spending or suppress interest rates for short-term political gain, it could lead to dangerous distortions. That's the path countries like Argentina and Turkey have walked. And it rarely ends well. So how likely is this black swan event? Most economists agree, very unlikely in the short term. The U.S. still has strong institutions, deep markets, and the benefit of the doubt. But the fear persists, and not without reason. In uncertain times, even remote risks feel more real. That's why central banks from China to Poland are buying record amounts of gold. Not because they expect collapse tomorrow, but because they're preparing for a world that no longer runs on automatic trust in the dollar. The black swan isn't here yet. But the world is building lifeboats, just in case. So where does that leave us? Let's pull together what we've learned and look at the bigger picture. First conclusion: the collapse of the dollar won't happen overnight, but its dominance is quietly eroding. The process is slow, but it's real. We're watching a tectonic shift in global finance, not a sudden earthquake, but a gradual movement that could reshape the world economy within a generation. The system that made the dollar indispensable is being questioned, tested, and slowly bypassed. Countries are diversifying their reserves. They're experimenting with alternative payment systems. They're hedging against a future where dollar dominance is no longer guaranteed. Second conclusion: the United States is losing more than just currency advantage. It's losing leverage. For decades, America's economic power was amplified by the dollar's role in global trade. That gave Washington the ability to impose sanctions, influence policy, and project power without firing a shot. But as that power fades, so does America's ability to shape global events. The world is becoming multipolar, not just militarily, but financially. And that creates new risks and uncertainties for everyone. Third conclusion. The rest of the world isn't abandoning the dollar out of spite. They're doing it out of self-preservation. When you see your reserves frozen, your access to banking cut off, or your economy held hostage by political decisions made thousands of miles away, you start looking for exits. Dedollarization isn't about ideology, it's about survival. And that's what makes it so powerful. It's not a coordinated attack, it's a distributed response to a system that no longer feels safe. Here's the warning. If you think this doesn't affect you because you don't work in finance or trade internationally, think again. The strength of the dollar touches every part of your life. It determines how much you pay for gas, groceries, electronics, medicine. It affects your job security, your retirement savings, your ability to borrow. A weaker dollar means higher costs and lower purchasing power. And while the collapse isn't imminent, the slow erosion is already underway. Ignoring it won't protect you. Understanding it might. The global financial system is shifting beneath our feet. Most people won't notice until it's too late. But you're not most people. You're here, paying attention, asking the right questions. And that puts you ahead. So what should you do? Stay informed. Watch the data. Follow the trends. Diversify your own financial position if you can. Hold assets that aren't tied to a single currency or a single country. Think about what inflation and currency instability mean for your long-term plans. This isn't about panic, it's about preparation. The dollar has been king for 80 years. But history teaches us that no empire, no currency, and no system lasts forever. The question isn't if things will change, it's how you'll adapt when they do. And the time to start thinking about that is now. If you made it this far, you actually want to understand what happens when the dollar loses its throne, not just read headlines. That's rare. Subscribe for new research tomorrow. Drop a comment. What currency do you think will rise if the dollar falls? Your perspective matters.